not a risk, not this decade, not in the next decade. What we're trying to do is eat the junk bond market, and then we want to eat the corporate credit market, you know, and the CFO of Microsoft may get some pressure from us in a decade. But right now, if you were to talk to Apple and Microsoft, they don't think they're competing against Bitcoin-backed bonds. And certainly the Treasury Department and the Bank of Japan doesn't think that either. And so I don't think it's a helpful narrative. I think it's a distraction. And what you ought to do is focus upon why this digital credit is better than junk bonds and private credit and a bunch of other things that people buy.
Hey guys, welcome to Everyday Finance. Bitcoin has been misinterpreted for years, first written off as a fraud, then as a fleeting trend, and finally as a worldwide menace. But in spite of ongoing skepticism, its worth has increased from a few dollars to more than $100,000. Michael Saylor, executive chairman of MicroStrategy, claims that this trend illustrates how society reacts to significant disruptive ideas. Initially, they are ridiculed, subsequently opposed, and ultimately, they are embraced. He thinks that resistance is a necessary component of development, and that the more resistance there is, the greater the change that will occur. Like many revolutionary ideas in history, Saylor is sure that Bitcoin will eventually go from dispute to consensus. In his most recent analysis, he explains why Bitcoin is only strengthened by each wave of skepticism and why the next adoption phase may be unstoppable.
I think it's simple. You raise as much equity capital as possible. You buy an appreciating asset, Bitcoin. And then if you enter into any kind of credit transaction, you obsess over the credit risk. Like how do I bankrupt the company? Let me reverse it. I raise $1 billion, I borrow $1 billion, I buy a bunch of Bitcoin mining rigs that depreciate 50% a year, and I borrow the money for 12 months and I pay 15% interest and I have to pay it back in 18 months. So if you borrow short term and buy depreciating assets, you'll be bankrupt in 36 months. If you borrow long term and buy appreciating assets, you'll be around forever. The challenge is just what I said earlier in my presentation. The people that want to give these companies money are going to want to give you the money and take short-dated senior credit instruments. And here's the hierarchy. A pipe, that's the worst way to get money, okay? And what I mean by that is if one credit investor approaches a company and offers to invest, and then they craft all the covenants, they make themselves senior, they give themselves liens on everything, right? There's no negotiation, there's no liquid market, right? That person basically has a chokehold on the capital structure. That's why you don't really want to negotiate with one company on a credit transaction. The next best is 144A. You're selling a bond, a junk bond or a convertible bond to up to 60 investors, one market maker. It trades over the counter, which means it doesn't trade. Over the counter means it doesn't trade. It's very illiquid. The next best is you take something public and you sell it to 100 million people. That's good, right? That's hard, right? And so I think that you just want to be very careful about what kind of money, what kind of credit you sell, who you sell it to. And it's one of those things where the easiest credit to sell is the most constrictive to the capital structure. And the hardest credit to sell is probably the most profitable thing you'll ever do. Bitcoin is going up 30% a year. So if you agree to pay a Bitcoin dividend, you are borrowing money at a 40% interest rate. And so my view is you ought to borrow money at 10% or less, and you ought to invest it at 30% or more. When you talk about Bitcoin yield, you're inverting it. You're basically saying, I'm going to give you 60% interest, and I'm going to go find a way to outperform that. And the whole premise of the industry is there's no way to outperform Bitcoin. Okay, so I'm not a fan. I don't think you should do it. I don't believe in Bitcoin dividends. I think that what you ought to do is fund in the weak currency, the yen, the Swiss franc, the euro, the dollar. You'll pay anywhere from a base rate of 0% to 4%, tack on 400 basis points, give that to credit investors. If you want a Bitcoin yield, my answer is buy the equity, right? The way that we give you Bitcoin dividends is you buy the equity and we generate BTC yield. You can do it safely in the equity, but the point is we don't promise you 30% BTC yield for the next decade because that's impossible to promise. So I leave the yield for the equity and then fund with the credit. If you get that inverted, of course all the Bitcoiners would love to get the Bitcoin dividend. Of course they do. But the point is you've just found a way to borrow money at 60% a year. And now you've got to go invest it at 80% a year return to capture 20. I just think that is like a bomb in the balance sheet. I think it blows you up. That's my opinion, and I have very much, discouraged people from agreeing to pay the Bitcoin return for their debt. I don't agree with it because, as a practical matter, nobody that buys sovereign debt will even talk to us. Like there is zero chance that someone that's using sovereign debt is going to swap out, their sovereign debt for a Bitcoin-backed credit instrument, right? We can't get rated. We can't get an investment rating. If you did get a AAA investment rating, if you were Apple with a AAA investment rating, you still wouldn't be viewed as competitive to sovereign debt. So if we climb up the ladder and we get AAA investment grade rated, we will be competing against Microsoft and Apple debt. And right now we're competing against private credit and junk bonds and ETFs preferred. So really that's the market, junk bonds. By the way, our debt trades at the same level as distressed debt, basically bankrupt companies going bankrupt. That's what it trades at. So it's not a problem, right? Sometimes the Bitcoin maxi thing is, well, oh no, you're going to topple the government and collapse the currency and blah. What happens when the politicians figure out that you're going to collapse the dollar? It's like not a risk, not this decade, not in the next decade. What we're trying to do is eat the junk bond market, and then we want to eat the corporate credit market. And the CFO of Microsoft may get some pressure from us in a decade. But right now, if you were to talk to Apple and Microsoft, they don't think they're competing against Bitcoin-backed bonds. And certainly the Treasury Department and the Bank of Japan doesn't think that either. And so I don't think it's a helpful narrative. I think it's a distraction. And what you ought to do is focus upon why this digital credit is better than junk bonds and private credit and a bunch of other things that people buy.
According to Michael Saylor, the flexibility that Bitcoin offers people to choose where their trust is placed is its true strength. Without requiring permission from anyone, you can transfer money anywhere in the world. Hold your own keys, depend on a custodian, or change control at any time. According to Saylor, this adaptability is Bitcoin's greatest gift, a system that recognizes that genuine growth requires human cooperation while transforming mistrust into individual freedom. It's about giving people the freedom to decide how they interact with a connected environment, not just about independence.
I think that there's a host of ways to put it to work. For example, when we sell credit, we're putting our capital to work. So when I sell Stride at 12.5% and you give me $1 billion, I generate $1 billion of Bitcoin yield up front, and I get about 80% to 90% of the back-end economics. And so the company makes $10 billion over 10 years when we sell Stride. That's a way to put it to work. By the way, what's the problem with it? I have to sell it. Like, would I sell $1 trillion of it? Yes. Can I? No. So there's a lot of ways like that. Stride, Strike, any credit instrument. I could sell a lot more convertible bonds. They have a 3-year duration, and they have a much wider credit spread, and they have a lot of credit risk. I could try to sell junk bonds. Now, what I said was, I could go write reinsurance, right? That'd be a new kind of risk. I could go borrow money by pledging my Bitcoin, and now I take counterparty risk to the borrower. There's a lot of, I got a chance to put my money with FTX, Genesis, BlockFi, 3 Arrows, and Celsius. They all came and sold. The salespeople will knock on your door and give you the offer. All of them have different risks. So I'm not going to say what a Bitcoin treasury company should do. They're going to have a stack of capital, and their choice is, do I want to do a deal with a bank? Do I want to do a deal with a crypto exchange? Do I want to do I trust the DeFi protocol? Do I want to put my, Bitcoin out on do I want to put on the ETH network, the Solana network, the whatever network? Do I want to post it to Hyperliquid or Binance? They're all counterparties. And there's no right answer, right? Except in theory, the right answer is I keep my Bitcoin and I use it as collateral and I borrow money and someone else gives me the money. That's right way risk. When I do that, the only risk we have is the custodial risk. Don't lose the Bitcoin. In theory, that is the risk-free way to generate yield. It's a good gig if you can get it, right? You just have to be, what do you mean? You have to go sell the credit instrument. So selling prefs to the public market is the hardest. Selling prefs in 144A transactions is easier. Selling bonds in 144A transactions is easier. There are other Bitcoin companies, they post their Bitcoin on exchanges, they borrow against it. The issue is, who's the counterparty? Do you trust them? Is it a good deal? Maybe. I can't endorse it unequivocally, right? Because that was the brilliant, idea of Genesis, and they went bankrupt. At some point, someone will mismanage a credit control. Here's what I say about this in general. Every company, public or private, is free to use their collateral the way they like, and there's going to be 100 different things you can do. But it used to be everybody got in the reinsurance business after the last hurricane, and that because every company got wiped out, and so they all launched the new reinsurance companies. They're like, this is great, we're getting 12% cash on cash yield. Then they all got wiped out by the next hurricane. So sometimes it looks good and it's too good to be true, and then it doesn't, but they're all just different businesses. Private companies can move into any of them. They can. Here's what I say about a public company, and I'll shut up. The thing about a public company is the reason the equity has value is because the equity investor understands your business model and wants to own it, wants to own a piece of it. So for example, if you gave me a choice, would I rather make $1 billion a year selling preferreds, or would I rather make $5 billion a year selling some preferreds and doing some hedge trade and selling derivatives and borrowing some money and writing some reinsurance? As a private company, if you have a large ego, the answer is the latter. As a public company, if you've lived through 30 years of pain and agony, and if you've been humbled having done a bunch of things, and you've seen what works, you would choose the former. I would rather make $1 billion in a simple way that's transparent than make 5x that much in an opaque, heterogeneous way. And the reason why is because the people on the other side of the trade, the investors, they need to be able to understand your business, and they need to understand it in a split second. And as soon as you take on each additional counterparty, you create new attack surfaces for the short sellers, new attack surfaces for the complexity, new risks, new sources of entropic lapse. And so this manifests itself in the Wall Street business, where it's like you're a hedge fund and you have PhDs at Goldman Sachs and you make billions of dollars doing complicated crap. You trade it like 5 times, 6 times earnings. You sell sugar water like Coca-Cola and you trade at 40 times earnings. And one business is dirt simple. Apple selling the iPhone, their P to E tripled. Apple doing something we don't understand and a lot of different things that are cool that are hard to do. If I don't understand it, the P to E's collapse. So I think if you decide to do it, I would say the company, the Treasury company, should just do that thing. And they should focus on it because you want your equity investors to believe in the same thing. Whatever counterparty risk you're taking and whatever kind of credit risk you're taking and whatever execution challenges you're taking, you want everybody on the equity side to understand, because the final boss, the people that let me do what I do, are the equity investors. And every week I put out a press release. It's like, okay, well, that was the Bitcoin yield. And the equity investors want Bitcoin. And so Bitcoin yield going up, good. Bitcoin yield going down, not good. That creates the trust. And at that point, you'll bring hundreds of billions of dollars of capital to you because people understand it. When you get heterogeneous, complicated things, then you lose the connection to the equity investor, and now your multiples collapse, your premiums collapse, your liquidity collapses. Yeah, you want to be so transparent that the haters, I want people, like, do you know we're the most shorted stock and the most shorted security in the entire crypto ecosystem? Like 3 times as shorted as IBIT. That's a badge of honor for us. What that means is everybody trusts us to be long Bitcoin, and they want to short the thing that's double long Bitcoin if they want a short position. So every time you come up with another idea, you dilute that, you distract, you make more complicated, and things that make total sense for a private company or a private hedge fund guys don't always make sense for a public company because of the reflexivity throughout all the layers of your other creditors and investors.
According to Michael Saylor, early adopters who saw Bitcoin's promise from the beginning would really benefit from its ascent, not the organizations that are now joining the market. Nearly $1.8 trillion in new wealth was produced when MicroStrategy started buying at about $9,000 and Bitcoin later rose above $115,000. The majority of this money went to people who already owned Bitcoin. Saylor has a clear message for small investors. You contributed to the founding of Bitcoin because of your early conviction. When businesses embrace it, they are strengthening and expanding that base rather than replacing it. According to him, riches and freedom of the original holders who helped spark the network are increased with each new member that fuels it.